Hey everyone, Nike reported fiscal year 2024 second quarter earnings results on December 21st that sent the stock price falling significantly. That left a lot of investors asking, should they buy this dip in Nike stock? That's an interesting question and one I was considering as well. Nike stock has been on my list of stocks that I want to add to my portfolio, and I've been waiting for a better buying opportunity. And I'm thinking this might be it, but I want to take a closer look. So jump in with me and let's dive into the details of Nike's latest quarter, why the stock price fell, and if this is a buying opportunity.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so in Nike's second quarter, revenues came in at 13.4 billion, which was up only 1% for Nike. This is a slower than expected growth rate for Nike, especially considering the expected rebound in the economy in China. The reason for the decline, one of which is wholesale revenues, which came in at 7.1 billion, which was down 2% year over year. Now, let me remind you a strategy Nike started, I want to say about 3, 4, 5 years ago. Nike decided that its brand is strong enough to go direct to consumer, that it wanted to cut out the middleman. Why make deals with Foot Locker and Macy's, etc., and give them lower prices at wholesale inventories and eat into Nike's profit margin? Why not just go direct to consumers, sell their products directly to their customers, and earn a better profit margin because they don't need to offer customers wholesale prices? Well, that's a strategy they started several years ago, and it had been working quite well as revenue was increasing, customer demand was increasing, and Nike's profit margin was expanding. However, in the latest quarter, it came back to bite them. Now, this doesn't mean that the strategy wasn't a smart strategy or one that they should have done. It just means that in the latest quarter, the confluence of factors worked against Nike and this strategy. I still think that it was a prudent strategy for management to undertake. Let's expand on why this quarter in particular made this strategy stand out as a headwind. Still, gross profit margin increased by 170 basis points to 44.6%. So, despite the fact that revenues fell, the gross profit margin increased because more of the revenue was coming from direct to customer sales and less of the revenue was coming from wholesale. The wholesale channel is decreasing in importance for Nike, although it is still important, right? 7.1 billion in sales, more than half of its overall sales in the second quarter, but it's becoming less and less so because Nike is diverting away. And if in fact it cut ties with a lot of wholesalers, and with others, it just told them that they're going to decrease the inventory they send them. So some items you can only get directly with Nike. You're not going to find them with their wholesale partners. And so that makes customers seek out Nike more often, seek out the website, seek out the app, seek out Nike stores, and those sales come at higher profit margins. So, one of the things that came from the outlook is that the CFO said that the second half is going to be softer than expected. So, we talked about how this was the second quarter for fiscal year 2024 for Nike. Management thinks the third quarter and fourth quarter are also going to be soft, and they're going to be softer than initially expected. So because of that, the company is identifying opportunities to deliver up to 2 billion in cumulative cost savings over the next 3 years. As part of that, the company is going to undertake pre-tax charges of approximately 400 million to 450 million that will largely be recognized in the next quarter. Now, if you've been following my channel, you know I'm not a fan of these types of cost cutting where you cut employee counts, but at the expense of massive severance packages. And so 400 to 450 million is a lot of costs to take just to lay off employees. I prefer companies when they decide they want to shrink in size to do so by shrinking the hiring, to stop hiring, to encourage employees and help them find other employment instead of firing them and paying them severance. That's expensive. That's a more expensive way to cut employees. And I think it's not as effective because you're going to cut employees that really want to be there. Whereas if you go by the self-selection route, the employees that are no longer enthusiastic about working at your company, they're going to slowly quit, and thereby you keep the employees that really want to be there and you shed those employees that don't want to be there, and you save on the severance costs. I prefer that strategy, and it's just more humane as well. People don't get fired, which is better for morale for the rest of your company. And so these types of layoffs, I don't like. I like cost cutting. I'm a big fan of cost cutting, especially when corporations reach this size. There's a lot of waste in there. So yes, I like cost cutting, but I like the cost cuts to be in areas like management perks, management salaries, in executive compensation, in spending on office parties, in travel, in things like that, and not in having to fire people and pay these severance charges. So I'm not a fan of this move. Still, I like that they're undertaking some cost cutting in getting the company to the right size given the excellent growth they experienced coming out of the pandemic. So here's another reason why I think Nike is experiencing this slowdown, and it's an inventory problem. Nike's inventories were $8 billion as of November 30th. That was down 14% compared to the prior year, reflecting a decrease in units. Now remember, I've been following Nike stock for several years now, like 5-6 years. In the aftermath of the pandemic, Nike overinvested in inventory because for a while, it experienced a surge in demand where it just didn't have the inventory, and it was wishing that it had more inventory because consumers were absolutely unleashing pent-up demand for Nike products. And so it overinvested in inventory. And then economies started reopening and consumers wanted to go out and they wanted to spend money away from home. And Nike was left with all of this extra inventory that it built up just as customer demand switched to a different category. And so what Nike decided was, look, we have all this extra inventory for 2023. Let's not rebuild inventory. Let's work down this inventory. Right? So they didn't invest in new product, in fresh product as much as they typically do. And it shows, right? Customers looking at Nike's products were like, this is an old product. These are old styles. We're not really excited about this. And so we're not going to buy it. And they showed with their spending. And I think that was partly also to blame for Nike's tepid demand in the current quarter. The freshness of inventory, not just the value of inventory, but the freshness, because I suspect this inventory that Nike has been around for a while. And customers, especially Nike customers, right? Nike customers are, ones that are shoe enthusiasts, sneaker enthusiasts, sneakerheads. You've heard of that term, right? So when they see the same style over and over, they're going to say no thank you. They're going to wait for the fresher style. So that was partly to blame, in my opinion, as well. And this is a short-term factor. This is something that Nike is going to refresh. They just wanted to work down this inventory because it was way too much and it was a risk on the company. They wanted to work this down. By the end of its fiscal year 2024, over the next 2 quarters, I think this inventory refresh cycle will be completed. They'll work down some of that older inventory, and starting in their fiscal year 2025, they'll have a more fresh assortment of product. Longer term, Nike has been excellent in terms of profitability. Their operating profit margin comfortably in the double digits, right? This big fluctuation due to the pandemic down and up, but for the most part in the double digits, 11.76% in the most recent trailing 12-month period. Cash flow from operations, similarly in the last decade, they've done an excellent job actually increasing this number from around $3 billion in 2015 all the way up to $5.418 billion in the trailing 12-month period. And they've done this more recently with a lesser importance on wholesale partners, which means this is a more sustainable and durable cash flow generating model because you're going direct to consumer. You're not relying on wholesalers, you're not relying on partners to sell to their customers, right? You're directly reaching your customers. You're getting these customers to visit your website, create an account, download the app, and so now you have more of a connection to the customer. And so this is a more valuable cash flow. This is a more valuable sale than it was in 2017 or in 2018. Finally, Nike's valuation is now very attractive. It's trading at a forward price to earnings of 25.4. You've rarely been able to buy Nike stock at this valuation. Briefly, you've been able to buy it a little bit below, but for the most part, Nike stock trades at a forward price to earnings that's above 30. And it's been that way going back several years. So you haven't had too many opportunities to buy Nike stock at a valuation this cheap. So given the longer term strategy Nike's trying to accomplish by going direct to consumer, which I agree with, that's an expansionary strategy that increases its profit margin, deepens its connection with customers. And given the inventory problem, I think is a more short term issue. I'm saying that this is a buying opportunity for Nike stock. I think at this valuation, this is attractive, and I think it is a buy on the dip. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.